It's about once in a decade that you get this sort of alignment of opportunity in one market, and I'm really looking forward to trying to get it right.
Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping on every order, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 40,000 new customers who have recently made the switch to SD Bullion. Why pay more?
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Rick Rule, the President and CEO of Sprott US Holdings. Rick, thank you so much for joining us today.
Thank you for having me on again.
Now, last time we had you on was a couple months ago, and you were saying that one of the things you highlighted was the trading action between gold, silver, and the US dollar. You were saying they were all trading up, and that was extremely bullish for gold and silver. Can you give us an update on these three markets, gold, silver, and the US dollar, and where you see them heading in the near future?
It would appear, at least in the near term, that that the dollar is beginning to roll over. As discussed in the last interview, if that is true, and if past is prologue, you'll remember that I referred to markets that we've observed in 1975 and also markets in 2001. This could be pretty bullish for the gold market, and later, I think, for the silver market. My experience has been that the silver market follows the gold market, but then outpaces it. And I think also could be fairly bullish for the precious metals equities. Now, it's always possible, because the data that we're talking about is 10 days old, that this could be a false start. But if, in fact, we are into a period like we saw in 1975 and like we saw in 2001, where gold does relatively well in U.S. dollar terms during a U.S. dollar rally, when both gold and the dollar do well against other currencies, and then the gold rolls over, in the past, that's been very bullish. I'm not prepared to say that's what's occurring now, but it sure feels like it to me.
Now, one of the other markets that we've been paying close attention to is the stock market. It seems like it's been, rising ever since Trump was elected. What is your perspective on the recent price action in the stock market right now?
It appears, at least, that the stock market activity that we've seen for most of the year has been fairly concentrated in a few names. The large technology stocks, as an example, until the last 2 or 3 weeks, have been truly spectacular performers. The broader base stock market has not performed as admirably as those few stocks have, at least for the last year. It's important to note that the messages sent by the overall stock market are, at least from my point of view, mixed. We note, on the one hand, that the economy in the U.S. and overseas, while perhaps recovering, is soft. We also note that interest rates are very, very low, and central bank policy on a worldwide basis is accommodative. Looking at large cap U.S. stocks, the good news about them is that the balance sheets and the income statements are robust indeed. The lessons of the financial crisis of 2008 were learned by corporate America, just not by our governments. And so the balance sheets are in extremely good shape. And of course, their cost of capital is low. On the negative side, you have situations where the valuations are beginning to look rich. And when I say rich, not necessarily forward-looking in terms of future earnings, because I don't do that very well, but cash flow relative to enterprise value being defined as market capitalization, less debt, plus cash, and also relative dividend yields. The dividend yields relative to any metric are fairly high in these stocks. And I think the support in the general market securities may have to do with the fact that income is largely unavailable through other sources. That is, bond prices are very high, incomes are very low from bond yields. And also, of course, the various credit products offered up by the financial services industry, like bank certificates of deposit, are yielding very, very low rates. So the message with regards to general market securities, I would suggest, is fairly mixed.
Now, what do you see for the precious metal mining stocks right now?
We had an absolutely spectacular 2016 in the precious metals mining stocks, admittedly off a very, very oversold bottom in 2015. The precious metal stocks declined post 2016. It was almost impossible for them to keep going. But interestingly, they declined by all measures, including relative to the price of gold. My belief is that absent a general securities bear market, that is, if we have a decent general securities market, that the gold stocks are set for a real rebound. They have lagged, and in particular, the small capitalization precious metal stocks have been slammed by the GDXJ rebalancing. And I think there's going to continue to be dislocations in the small gold stock market with the GDXJ, even post the rebalancing, because the GDXJ, the Junior Gold Miners ETF, has become such a large and successful product that rather than having the sector lead the ETF, the liquidity in the ETF has begun to control the sector. That is, that companies that are components of the ETF have, at least in the near term, managed to outpace non-GDXJ components. I believe that the way you play that, provided it continues to be true, is you look at the companies that have very high share prices as a consequence, of large ownership by the ETF, and you find companies that are good strategic fits for them in takeovers. In other words, companies where their share prices are lower because they're not GDXJ components, and try and figure out which GDXJ components need to take them over. I think that this is an opportunity that will be red hot in the next 12 to 18 months, a real market anomaly. A sector, gold, which feels to me like it wants to go higher, a subsector, gold stock, that is due for a tremendous rebound if the gold stocks do go up, and a market anomaly, an artificial pricing anomaly caused by the GDXJ that will lead to some real takeover arbitrage opportunities. It's about once in a decade that you get this sort of alignment of opportunity in one market, and I'm really looking forward to trying to get it right.
Definitely. And so it sounds like you're seeing both physical precious metals and also the stocks to increase significantly going forward.
That's certainly my suspicion. I mean, the reasons why I like gold. I'm nervous about the U.S. dollar. I'm nervous about the very low yield on the U.S. 10-year Treasury. I'm nervous about continued accommodative federal policy. So all of those things leads me to believe that it's likely that gold goes higher sooner rather than that gold goes higher absolutely. What leads me to believe that gold may go higher sooner rather than later is simply the beginnings of the rollover in the dollar price. If that continues, I think gold could surprise people. I'm not saying it will, because technical analysis is not my forte, but it certainly feels like the dollar would like to roll over. And if that happens, once again, if past is prologue, the gold price could do very, very well.
Now, do you think this dollar rolling over is partly caused by the Fed raising interest rates recently?
That should have strengthened the dollar. My suspicion is that the dollar has rolled over simply as a consequence of 18 to 24 months of outperformance. The same way that the gold stocks rolled over in late 2016 because they had outperformed. In very inelegant phrases, maybe because they were due for a rest. Makes me think that the dollar may be ready to roll over too. The dollar has put in a remarkable performance in the last 18 to 24 months versus most currencies. And for all the sins that we document with regards to the U.S. Fed and the dollar, as my friend Doug Casey says, the U.S. dollar is still probably the prettiest mare at the slaughterhouse. At some point in time, that outperformance begins to wear thin. And we may be seeing that now. If I'm wrong about the strength of the U.S. economy, that is, if the U.S. recovery gets underway in earnest and they can get away with an interest rate rise, then I think you'd see renewed dollar strength, and I think you would see gold weakness. I don't see that in the cards. I wonder, with the aggregate indebtedness of the U.S. federal government, state governments, local governments, and consumer debt, and in particular with the impact it might have on the mortgage market and real estate markets, I'm not sure how much interest rate rises the economy would be willing to take easily and the politicians would put up with. Again, I'm not a political analyst, I'm a credit analyst. But I know that there would be stresses in the economy if the interest rate went up too much further. You will remember about a year ago when the Fed raised the interest rate 25 basis points and the market on the U.S. 10-year Treasury raised the interest rate by about 90 basis points. If that same circumstance wields its way through the economy, meaning that if the Fed takes up the rate by 25 basis points and the market amplifies that rate rise, one wonders what the economic impact of sharply higher interest rates would be. I suspect not good.
So, right, if the Fed continues to raise interest rates, can you expand a little bit on where you see the U.S. dollar going?
I think if they got away with the interest rate rises, that would surprise everybody, and the dollar would go higher and gold would go lower. If we saw a circumstance where there was real U.S. dollar strength, not merely strength in the face of other people's weakness, that is, if the U.S. economy demonstrated that it had real strength and wasn't merely reliant on the subsidy from low interest rates, that would be a genuine shock and surprise. I would certainly be shocked and surprised.
I also asked viewers to submit questions today, and I was wondering if we could move to that.
Be delighted. Thank you.
One of the first questions here is about uranium stocks, and they were saying that you had advocated a patient approach to uranium stocks. What is your perspective right now on that sector?
Absolutely unchanged. The price of uranium is unsustainably low, but the circumstance that will cure that is difficult to time. Specifically, the most important factor in the uranium price in the near term is the pace of Japanese nuclear reactor restarts. The consequence of Fukushima is that the world's second or third largest nuclear fleet was taken offline. And the consequence of that was that an awful lot of demand went away, while the inventories of the Japanese plants came to be regarded as supply. The restart or the pace of restart of the Japanese nuclear fleet is the most important determinant as to uranium pricing levels in the sort of 12 to 18 month time frame. You saw the incredible run that uranium stocks had at the beginning of 2017, doubling and tripling. That was a very, very interesting market. I suspect what happens is that the market had really literally used up the sellers because the small uranium stocks doubled and tripled on very, very little volume before the new round of buyers was disappointed by continuing price action in uranium. That tells us a couple things. One, if you're going to play this game and you're going to be early, you're going to have to be patient because there will be false starts and false stops. But the other thing is, and you'll have to pardon this pun, Elijah, the uranium stocks are truly an explosive asset class. The memory of the last bull market in the beginning part of the last decade, where the junior uranium stocks went up 20-fold and 30-fold, is still fresh enough in people's memory that if you give them an excuse, a plausible reason to buy uranium stocks, they will buy them aggressively as a consequence of not missing one of those spectacular bull market moves. I do believe there's the possibility of one or two more false starts in the uranium equity market before we see the pace of Japanese restarts really firm up the uranium spot market.
Now, moving on here, this viewer is wanting to know your perspective on the cobalt market right now.
I'm attracted to the cobalt market, but of course everybody is. The problem with the cobalt market is, first of all, in terms of a way to play physical cobalt, that's very difficult to do. There's nothing out there like the Sprott Gold Trust, the Sprott Silver Trust, or the Sprott Platinum and Palladium Trust to play the physical cobalt market. And the cobalt stocks present some real difficulties for us. The reason is that economic concentrations of cobalt, that is, cobalt that can be mined for money, really take place only in two countries. One is Congo, which people hate, and the other is Russia, which people hate. What investors seem to want is politically secure cobalt, that is to say, Canadian cobalt. And thus far, Canadian discoveries have been too small to be really, truly economic. So you have a real conundrum. I believe that the cobalt price goes higher, but I also know that in order to play it on an equity basis, I have to go to Congo or I have to go to Russia. I am personally willing to do that, but many people aren't. The plausible answer may be lateritic cobalt in Australia. The discoveries haven't been made to justify the type of market caps that we would be looking for, but that would seem to be a place that has a pro-mining culture, that has the right geology, that has the sort of lateritic deposits that could give us size and would be politically acceptable to speculators.
Now, for the last viewer's question, we've talked many times before about how gold and silver, in your view, are really insurance for the future. Now, I'm not sure exactly how someone can answer the following question, but you can take whatever angle you'd like. They're asking, how many ounces of silver bullion will protect my future?
That is a very difficult question because it really depends on the lifestyle that somebody wants to, enjoy. I tell many investors that gold and silver, and really in the mix that you select, should be about 10% of your portfolio, but the number varies up and down depending on the other asset classes you have. As an example, if your portfolio is largely made up of long-term municipal bonds, where your financial future could be ravaged by inflation, then you need a higher allotment of gold and silver. You need more protection against inflation. If by consequence your portfolio is comprised of prudently leveraged developed real estate, where the replacement cost of the real estate goes up with inflation, in other words, where you have some inflation protection built into your portfolio, you need less gold and silver as protection. There is no one-size-fits-all answer, and I'd need to know an awful lot more about the questioner's circumstance before I could describe what I thought would be an appropriate strategy.
All right. Well, Rick Rule, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you'd like to add?
Absolutely. In terms of last thoughts, people need to remember that our upcoming Sprott Vancouver Natural Resources Forum, which I believe is the finest investment conference in the world with regards to natural resource investing, takes place July 25th through 29th in Vancouver. You can come to our website, www.sprottglobal.com, to find out about that. And if you have a general interest, a less specific interest, go to the website, and you will find about 200 hours of free instructional material about precious metals and natural resource investing. I invite you to search the website and forward any questions that you might have to contact@sprottglobal.com.
All right. Once again, Rick Rule, thank you so much for your time today.
Thanks for the opportunity. I enjoy it.